Here is the number most financial advisors will never give you. The exact percentage of Bitcoin you should hold based on your age. Not a range, not a vague, it depends. A real framework built on math and risk logic that you can apply today. If you are 40, 50, or 60 and trying to figure out how much Bitcoin is smart versus how much is reckless, you are in exactly the right place. Stay with me. What you learn in the next 8 minutes will change how you think about every asset in your portfolio. Here is what most people do. They Google, how much Bitcoin should I own? They get answers like 1 to 5%, and they feel vaguely reassured. Then Bitcoin goes up 40% in 3 months, and they quietly wonder if they made a mistake. That is not a strategy. That is noise management. The standard advice was built for a world where Bitcoin was purely speculative. No track record, no institutional backing, no clear role in a serious portfolio. That world no longer exists. Bitcoin has outperformed every major asset class over the last decade. It has survived multiple crashes of 50% or more. It has recovered every single time. And its supply is mathematically fixed at 21 million coins, forever. So the question is no longer whether Bitcoin belongs in a serious portfolio. The question is how much and when, based on where you are in your financial life. That is exactly what we are building today. Before we get to the numbers, you need to understand one idea. Asymmetric risk. Here is what it means. If you put 5% of your portfolio into Bitcoin and it goes to zero, you lose 5%. Painful, but survivable. If that same 5% grows 10 times, your overall portfolio is up 50%. The downside is capped, the upside is not. This is why sophisticated investors and institutional allocators have started treating Bitcoin not as a gamble, but as an asymmetric hedge. The question is not, can I afford to own Bitcoin? The question is, can I afford to own none? Now, here is where age changes the calculation entirely. Your risk horizon is the time you have before you need to draw on your wealth. Bitcoin rewards long-time horizons in a way almost no other asset does. A 40-year-old has 20 to 30 years of runway. A 60-year-old may have 10 to 15. That difference is enormous when you are dealing with an asset that moves in 4 to 8-year cycles. Here is the core law. The longer your horizon, the more volatility you can absorb. The more volatility you can absorb, the more asymmetric upside you can access. Now, the numbers. If you are 40, you are in the most powerful position in this conversation. Real capital, for likely the first time. 20 plus years of runway, and the maturity to think in decades, not days. The smart allocation at 40 is between 5 and 15% of your investable assets. Here is why that range exists. 5% is your floor. It captures meaningful upside while keeping your portfolio stable. If you are conservative, if you have dependence or concentrated business risk, 5% is the right number. 15% is your ceiling. Not because Bitcoin is too risky above that, but because position sizing is discipline. Above 15%, you start compromising your ability to stay calm during drawdowns, and staying calm is the entire game. The investors who built real wealth with Bitcoin were not the ones who bought the most. They were the ones who held the longest. At 40, your job is simple. Buy a meaningful position, then largely ignore it for a decade. At 50, the calculus shifts. You are 10 years closer to the moment when your portfolio needs to work for you, not just grow. This does not mean reduce Bitcoin aggressively. It means be intentional about sizing. The smart allocation at 50 is between 3 and 10%. 3% if you are within 5 years of a major liquidity event, a retirement date, a business sale, a large property purchase. 10% if your income is stable, your obligations are covered, and you are genuinely operating on a 10-year plus horizon. Here is the insight most 50-year-olds miss entirely. Bitcoin volatility is not the same as Bitcoin risk. Volatility is short-term price movement. Risk is the permanent loss of capital. Over any 4-year period in Bitcoin's history, holders who did not sell came out ahead. At 50, your greatest financial risk is not owning something that moves. It is owning nothing that keeps pace with the long-term erosion of purchasing power. Inflation does not announce itself. It quietly shrinks every dollar sitting in a savings account, every bond with a fixed return, every asset priced in a currency being printed without limit. Bitcoin is the only major asset with a hard cap on supply. That is not marketing. It is written into the protocol. No central bank can change it. No government can inflate it away. At 50, that property is not a speculation. It is a hedge. Now here's where the conversation gets most interesting. If you are 60, conventional wisdom says get conservative. Move into bonds. Reduce risk. For most assets, that logic is reasonable. Bitcoin deserves a separate analysis. The smart allocation at 60 is between 1 and 5%. 1% is not symbolic. 1% of a $2 million portfolio is $20,000. If Bitcoin reaches the price targets that institutional models project over the next decade, that position looks very different on the other side. 5% at 60 is for the investor who understands one specific strategy. Borrow, do not sell. Instead of selling Bitcoin to fund retirement expenses, you hold it as collateral and borrow against it at low interest rates. You keep the asset, you keep the upside. You never trigger a taxable event. This is already being used by serious wealth managers. It is not exotic. It is logical. And it is only available to you if you own the asset in the first place. At 60, the real risk calculation is this. Can you afford to be completely absent from the only asset in modern financial history with a mathematically fixed supply during a decade when every major currency is being diluted? That is the question worth sitting with. Now that you have your number, 3 rules apply whether you are 40, 50, or 60. Rule 1. Buy in stages. Do not allocate your full position in a single day. Use a consistent schedule, weekly or monthly purchases over 3 to 6 months. This removes the emotional weight of timing the market and lowers your average cost across cycles. Rule 2. Cold storage is not optional. If your Bitcoin sits on an exchange, you own a claim on Bitcoin, not Bitcoin itself. Hardware wallets are not complicated. They are insurance. Rule 3. Plan your rebalance threshold, not your exit. Sophisticated holders do not plan to sell. They plan to rebalance if Bitcoin grows to represent an outsized share of the portfolio. If your 5% position grows to 25%, you trim back to target. You manage the position. You do not abandon it. These 3 rules separate the strategist from the speculator. That distinction is worth more than any single price call. You came here for a real number, not a disclaimer, not a hedge, a framework. Here it is one more time. At 40, 5 to 15%. Long horizon, maximum asymmetric positioning. At 50, 3 to 10%. Intentional sizing, inflation hedge as the core thesis. At 60, 1 to 5%. Small position, significant optionality, borrow strategy on the table. The investors who look back at this decade with clarity are not the ones who waited for certainty. They are the ones who sized their position correctly, held through the noise, and let the math work. You now have the framework. You know what each stage of life demands, and you understand why the standard advice was never built for someone who thinks the way you do. If you want to keep building this kind of strategic thinking into your portfolio, subscribe. New frameworks every week built for investors who are done being talked down to.